Hi everyone, it's your daily 10-minute business and finance news wrap for this Thursday, the 3rd of November 2022. Later, why some Christmas party essentials may be in short supply this year. But first, we'll start with the Australian share market, which fell 1.8%. A pretty bad day, 6,857 on the ASX 200. It follows a US interest rate rise, 75 basis point increase to a range of 3.75 to 4%, and the US Fed signalled more rate rises to come. For more on his take and what it means for the share market and for inflation, I spoke earlier with Mark Gardner from Maqro Capital. Mark, the Australian share market tanking along with other markets around the region today. It follows a 75 basis point increase in US interest rates. What exactly don't investors like about the move? Because A, wasn't it expected, or was it more about future commentary?
It was definitely about the future commentary overall. I think what the market didn't like about it was Fed Chair Powell said basically any movements going forward will be data dependent. There'll be a higher threshold for that data for the aggressive rate hikes to continue. But any level of uncertainty, particularly in a bear market, and with the historically high level of volatility we've had over the last sort of 6 months, any form of uncertainty is generally taken badly, and usually ends up being results in selling. So, yeah, it was more about the uncertainty. Really, it was largely expected. They did soften their language, but the Fed's become very good at jawboning over basically since the GFC. And they know they shouldn't be changing their language too swiftly and shocking the markets. So I think having watched the Fed deliver these statements over a couple of decades, it's any change in the softening of language probably leads to what everyone was expecting, but they're not just going to give it to the market straight away, because there tends to be knee-jerk reactions, which is what the Fed's trying to avoid at the moment.
I've seen a lot of different commentary in terms of what Jerome Powell has said today, some suggesting that a peak in interest rates may actually be a bit higher. What do you think? Has the outlook for rates really changed, and how will that impact the market?
I think the Fed's really looking for more of a U-shaped sort of peak in rates rather than a V-shaped, which is what the market is expecting at the moment. I think the Fed even needs to be a touch more patient. To put things in context, there's only been 6 75 basis point rate hikes in the last 40 years, 4 of them in the last 4 months. And even in the GFC, when we were obviously cutting rates, going the other way, and the financial system was on the brink, we only saw 4 rate moves more than 50 basis points, and that was over 15 months, not 4 months. So I think the Fed really needs to review. I really take the RBA's lead here. I think it's a much more sensible approach, doing smaller and incremental rate hikes over a period of time rather than trying to front load everything far too hard. So I think they're, from a historical standpoint, they really are putting themselves at risk of overshooting here. And I think you would expect them, they've said obviously data dependent, but I mean, inflation's going to have to be incredibly high, and the labour market's going to have to be incredibly tight for them to sustain these sorts of rate hikes. I mean, we've just become a little bit too used to, the severity of these hikes. But if you go back and look at it historically, these are very extreme measures.
So is the fear then that the Fed might tip the US into a hard recession?
If they continue at this rate, I think it's undoubtedly going to happen. One of the leading indicators being the inverted yield curve is sort of at its lowest level, minus 52 basis points in quite some time. It reverses rather swiftly when it reverses, but I think somewhere around here is going to be the peak. The average rate cycle is around about the 4.1%. Mark from start to finish, and we are largely one more 50 basis points gets them beyond that. So I think, they at least need to take a breather, because we've basically had those 475 basis point hikes barely having a chance to even filter through to the actual real economy. So I dare say these guys are academics, they're economic historians. I think they'd be well aware of the fact that this is an unprecedented shift in rates, and they've said previously that they don't want to have a Volcker style induced recession like the 80s, where Paul Volcker was the central bank head there in the States, where they had to raise rates very swiftly and then reverse that. So it's not going to hurt them to wait a couple of months to have a breather. I've seen pundits talking of 25 basis points maybe next month. We'll just have to wait and see. But I think they'll probably utilise their jawboning skills that they had to sharpen with zero interest rates, and that's all they had. They'll probably soften the rate expectations verbally over a period of time.
Okay, a couple of local issues or local stories. Woolworths today posting a 1.8% rise in Q1 sales. It says that average prices across its supermarket up 7.3% for the quarter, seeing double-digit inflation growth in fresh fruit, vegetables and meat. How is inflation impacting these sorts of businesses, and are we now getting an idea of how consumers are coping?
Yeah, obviously these businesses are being impacted by, their margins being compressed. And look, and realistically, it almost circles back to the Fed, to the central bank talk, is that central banks are trying to address a problem here that is largely not really in their control. Ukraine-Russia situation in the form of sanctions or inability to be able to export food is about 25% of Europe's food bowl. There's a drought in North America. There's floods in Australia. Oil prices are high, so transportation costs are high. So really, this is not anything to do with necessarily a hot economy. So they're going to have to balance this quite delicately. But as I think, as supply. Being a supply-based inflation, I think, as we start to see, I think Russia came back to the table on the Black Sea grain deal yesterday, which forced down, wheat prices back down to reasonable levels. So the more we're seeing of that, and the more these supply chains reopen, the more crops they can get out, and obviously a shift of La Nina from our shores to the US obviously is going to bring on some supply there as well. So yeah, it really is one of those things that, if businesses' margins are too compressed, obviously that's, they're going to have to cut costs somewhere, and that may spell the worst for, say, the employment or the labour market.
Final thing, fund manager Perpetual rejecting a $30 per share takeover bid today. What's the appeal here? And given the broad market sell-off we've seen over recent months, do you think more takeovers are now on the horizon?
I think it's a reflection of, of the equity market nearing some sort of bottom. There's a lot of private equity coming in, scooping up long-term assets here at pretty low prices, and because their time frame is 10 years plus. So whereas a situation like last year, price earnings ratios were extremely elevated, and you didn't really see too much of that going on. I think the appeal for for this takeover is the same reason Perpetual recently acquired Pendle. It's economies of scale. Funds management is a relationship business, so you don't have the option necessarily to cut costs across your business in terms of staff, because funds may leave with the staff members. So I think in a very, very tough year for funds management, the likes of Magellan falling from $40 to the low teens, etc., is a consolidation is generally needed while these guys are having massive outflows, and so they can retake advantage of those economies of scale.
Mark Gardner there from Maqro Capital. One thing Mark mentioned or touched on there was Woolworths, which delivered a 1.8% increase in quarterly sales, also saying that supermarket prices across its grocery division up 7.3% in the quarter, driven by double-digit prices in fresh fruit, vegetables and meat. The company's CEO also said that floods are having an impact and may squeeze supply on some foods this Christmas season. Here is some of what Brad Banducci had to say earlier at a media conference.
Now, this again is a very dynamic situation for us, but the big issue right now is hopefully everyone is aware is in frozen vegetables in particular, corn and potatoes with the very poor growing season that we've had in Tasmania. And so that is causing some challenges in the frozen category and some risk of unsupplies in some stores. And that has also flowed through to some risks. I don't want to overplay anything at this stage in potato crisps. So there are some issues then for suppliers on the way through there. So that's the big one. There has been a delay to the cherry, the cherry season. And so all the seasonal fruits we'll just have to watch and we'll communicate as we go in a dynamic sense.
Brad Banducci there, CEO Woolworths. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.